Let's work some exercises in Chapter 7 then. And this will be addressing cost of goods sold, cost of goods available, ending inventory, and gross profit. We'll be using the periodic method. So it's the periodic and not the perpetual method. Our first problem here then, we have beginning inventory which consisted of 50 units at $10. We made a purchase on July 13th of 250 at $13, and then we're going to sell 100 units. And as I've said before, the selling price at this point is not too relevant when we're just trying to figure out how much we're going to have in value for cost of goods sold and for ending inventory. The selling price is not relevant. Now the selling price is relevant if we go in and we create our income statement, because the selling price times the number of units would give us our total revenue. If we calculated all of this under FIFO and we're using the periodic method, the first thing you should probably do with any of these methods is to calculate what goods available is going to be. And you can calculate goods available in terms of number of units, and you can also calculate goods available in dollar value. In this example, goods available is the beginning plus the purchases are 300 units. We don't have it put together in a way that we can look at this chart up here in the yellow and determine what the total goods available is in dollars. We're going to have to multiply it out, and that'd be 50 times 10 is 500, 250 times 13, 3250, or 3750 is goods available. Again, the terminology, sometimes they say cost of goods available for sale. I tend to phrase it as goods available. This 3750 is either going to show up in ending inventory or be cost of goods sold. And under the FIFO method then, what we're going to do here is say that the first stuff in is going to be the first stuff out. So when we calculate it and determine what our cost of goods sold is going to be, we're going to take these 100 units that are sold, first using up these 50 and then taking the remaining 50 from the July 13th purchase. So our cost of goods sold is going to be 50 at 10 and 50 at 13. Adding those numbers together, you get 1150. And then your ending inventory then is the difference between this and this, or 2600. Now, another way to do it though is to go up here and say, well, if I sold from this and then I sold 50 from here, I would have 200 remaining from this purchase on July 13th at $13, which gives me the 2600. So we're back to the equation, the all-important equation, which is goods available becomes either ending inventory or cost of goods sold. Now, if we do FIFO, if we do LIFO, if we do weighted average, our goods available is going to be the same as long as we have the same yellow setup up here. It's going to be 3750 because it's this times this and this times this. Doesn't change. It's always going to be 3750. The difference is going to be how much we put in ending inventory and how much we put in cost of goods sold. Under LIFO, again, you're going to still come up with this 3750 for goods available. It's just going to be a difference is going to show up in our cost of goods sold, because if the last stuff in is going to be in this selling of 100. So the last stuff in came from July 13th, and we're going to sell 100 of those items at 13. So they cost 100 times 13, or 1300 is going to be the cost of goods sold number. And if you have 100 taken out of here, then our ending inventory is going to be 150 times 13 plus 50 times 10, and that's calculated here. Again, the total of these two needs to add up to 3750, and whether we use FIFO, LIFO, or weighted average, as long as this in yellow stays the same, then our goods available should be the same by any method. Under weighted average, we said it was 3750 for goods available, and we can see up here goods available is 300 units. Therefore, the calculation's pretty easy. 3750 divided by 300 is 1250 per unit. So multiply 1250 times the 100 to get your cost of goods sold. Multiply 1250 times 200 to get your ending inventory. So, to summarize all of this, you can see that under the different methods, your cost of goods sold differs, and because your cost of goods sold differs, then your gross profit differs. And we know from a previous example that changing gross profit, you're going to also have to change your income tax expense, so net income will change from two reasons, because gross profit changed from cost of goods sold, and also your income tax expense will change. Now, this one is a bit tricky because I want you to continue to think about it as the periodic method, which means it doesn't really matter. The first step we need to do here is to calculate goods available. Okay, we don't need to be lost because we have a sale in the middle of all of this. Another sale here, another sale here. We're not really thinking about the order when we work through this because we're in the periodic inventory method. And that's all you really have to know for this chapter. We're not going to work through it using a perpetual method. In a later class you'll learn that, but in this class we're just using the periodic method. So going back to basics, the very first thing you need to do is calculate goods available. And goods available is going to be the 2,000 times 40 plus the 6,000 times 44 plus the 8,000 times 50. And you can extend that to get a value. And you could also add up the number of units. And here you have 2,000, 6,000, that's 8,000, 8,000, 16,000 units. So the goods available will be the same for all of the methods, and calculating it and adding it down, it's 744,000. So when we work through our problems, we need to have ending inventory plus cost of goods sold equaling 16,000 in units and 744,000 in dollars. This is important. You can use this when you work on your exams to double check your numbers to make sure your goods available and cost of goods sold get you to ending inventory. You're just remembering the equation. It should work whether you're using the units, whether you're using the values. Under FIFO then, your ending inventory is the remainder or what's left, and your cost of goods sold will be the first stuff that goes, the first stuff that came in will go out first, and if it's 2,000, you'll use 6,000, you'll use first from your oldest inventory, your oldest merchandise, your beginning inventory, then your next purchases, then your next purchases. And ending inventory will then become the last stuff which you have. When you do this under LIFO, your cost of goods sold is going to be coming from the bottom, or it's going to be coming from the last merchandise which you purchased, and then you're going to work your way up to get the numbers. So I want you to try to work through the problem and see if you can come up with those numbers. Under weighted average, Remember, we had $744,000 and 16,000 units to calculate our average price or our average cost. Averaging that times the multiplying by the number of units, you will come up with a number or a value for ending inventory and a value for cost of goods sold. Sometimes when you work through these problems with weighted average, I should tell you that you may not get exactly 744,000 for this plus this added together. And the reason why is because the number of decimal places you choose to put in this number when you multiply it here. So it's a rounding issue. Do try to come back to 744,000 for the total of these two combined. So take a little care in how you round. You may need to round this number even though it's technically not correct to have another digit here because we're talking about dollars and cents. You may need to use it in your calculation here so that these two numbers add up to the 744,000. Here is another problem, and they say sales total 240 units. Now, you can just look at this and you should be beginning to pick up what we're doing here. So goods available is going to be the sum of this in terms of units, the sum of this in terms of cost. When we say last in, first out, that means the 240 units that we are selling, 200 are going to be from this batch, and 40 are going to be valued at 90. So 200 will be valued at 110, and 40 will be valued at 90. And if that's cost of goods sold, then our ending inventory is going to be from the top. So first things first, you're going to calculate the goods available, which is 700 units. The value is going to be these combined for 65,800. So whatever method you use, you're going to find that ending inventory plus cost of goods sold is going to be, in terms of units, 700. In terms of value, 65,800. Now, how many units should we have in ending inventory is the question. Okay, well, we said we had goods available as 700 and we sell 240, so we have 460 units left. Been harder if they had asked us the value of those. And here we go with this one. Under FIFO, our cost of goods sold is the oldest values first. 240, 120 from this, 120 from this, that's where they're getting it. And if it's 120 taking out of this batch to become cost of goods sold, then we need to have 260 at 90 and remaining in ending inventory, and 200 at 110, which is going to be the other part of ending inventory. And you carry it across, you add the numbers together, and hopefully we'll come back to our goods available in terms of units and in terms of dollars. Same problem under LIFO. Again, we're selling 240 units, and it's last in, first out. So our cost is coming from the last stuff first. $200, 110, that's 200 units. We had 40 more, and it's going to come from here. So we're going to have 40 times 90 here for cost of goods sold. So 200 from 110 and 40 from 90 to get 25,600. And then you can work backwards in this and figure out where our ending inventory is going to be. Under weighted average, all you're going to do is calculate the average value per cost, or average cost per unit, and if sales is 240 units, it's 240 times 94 to get you the cost of goods sold, and the ending inventory will be the remainder. Lower of cost or market. Under lower of cost or market, we know that the value that they have it recorded in their balance sheet before they do this final step is going to be 50 times cost, and this is they've calculated their unit cost using FIFO, which is appropriate. They took it times this to get this valuation, etc., and calculating across to get these numbers. This is their total inventory, or their total inventory debit, their inventory asset in the current asset section of their balance sheet before they do the lower of cost or market rule. When they go up and do lower of cost or market, they need to go up and say, how much would this cost us today if we were to buy it today? And it only becomes an issue if the current market value is less than what they paid for it, or their unit cost when acquired. The first one, you can see there is an issue, right? Because they current price is 24, they paid 30. The second one, no issue. The third one, the market price is actually higher than what we paid for it. We don't do anything about that one. This one, same values, no issue. But on the last one, the elephant dressers, we find that our value, if we were to buy it today, would be 12. We paid 15. So the ones where we have the problem will be the first one and the last one. And it's because the market value for those is less than what we paid originally. Those are the only two items where we have a problem. And when you calculate this, you can go through and you can look at it and you can calculate lower of cost or market per item, and then you can go through and calculate it this way, or you can use the method I just did when we talked our way through it. And again, you're going to see that this is a recorded cost column and this is the LCM calculation. Our problems are with the first one, 1,500 versus 1,200, and the lower one, 6,000 versus 4,800. Otherwise, our lower of cost to market valuation is the same as our total recorded cost, or our inventory value cost. The only ones that given us a problem again are alligator armoires and elephant dressers. And the problem here is $300 here, and it's $1,200 here, because that's difference between 6,000 and 4,800 is 1,200. So a total of $1,500 is our issue with this. So when we do this journal entry, we're going to have to again expense off an asset, credit our inventory for $1,500, and debit cost of goods sold for the $1,500. This is inventory turnover and average days to sell inventory, and they want us to do this calculation for 2012, 2011, and 2010. They're very nice to us because they've already calculated average inventory. As I said before, it's beginning minus ending divided by 2, but we don't have to do that because they've already given us the numbers. So inventory turnover is cost of goods sold divided by average inventory, and days to sell is 365 days by the number we just calculated as our inventory turnover ratio. So this one would be 365 divided by 7.1. Okay, and if you need to see where the numbers are coming from, they also show us down here what the numbers are. So inventory turnover 7.1 times in 2012. In the previous years it was 7 times per year. We can say this is fairly steady. The other thing is days to sell. In 2012, it's taking slightly fewer days to sell, and that's a good thing. So how do they comment on it? The inventory turnover ratio reflects how many times average inventory was acquired and sold. The turnover ratio has been consistent, and then Polaris is performing better than Arctic Cat, where the inventory turnover is 5.4 times per year, or every 67.6 days. So in this one, you're comparing Polaris, and you're going to compare this to Arctic Cat, and they give us the number for Arctic Cat, and you make a comparison. It's fairly straightforward. We know that we want to turn over inventory as much as possible, and we want to have fewer days to sell the inventory. So those are the two ratio calculations from this chapter.